Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 1688, and it is a pleasure to have someone back on the show. You've heard her on before, but this time she is coming on for a different reason. Actually, she's coming on to share her client case study, and that is our longtime team member, Brittney Roberts. Brittney, welcome.
Thank you. I know this is my first visual podcast. I've been on before audio, but this is my first visual.
Audio only. We actually are on Zoom, so people could see this on the YouTube channel, but certainly on the Creating Wealth podcast, it's there. Brittney, you're coming to us from Chicago, and you started working with us back 13 years ago. That was at our office back in Orange County, California. Did you ever think this job would last this long?
I don't think so. I'm thankful that it has. I've learned so much, but at the time I had just graduated from college. I don't think I was thinking past maybe a year at the time, you know, how that, you know, when you're 22 years old, and I was happy to land a job during the time. And, you know, cause that started a recession time.
Right.
So jobs were kind of hard to come by, and learned a lot. I mean, I think that's kind of when at least one of the roller coasters started with real estate. And
it sure did. That was right on the precipice of the Great Recession. So
I got a front row seat to the
you saw all of that in the real estate business for sure. You went to Vanguard University, majored in public relations, and we hired you to do some public relations work for us, some PR, and we wanted to get out there in the media and get media attention. But it turns out you didn't really end up doing much of that. You ended up doing all sorts of other things, right?
Yeah, I've worn lots of hats over the years. I've done marketing, I've done design, what haven't I done? I feel like at the time we had, you know, many people. It was a booming office, but lots of people working, and we kind of downsized over the years and then, you know, grew again. So I don't think there's much. I haven't been technically an investment counselor. I've sourced some properties, but that's probably one of the only roles that I haven't done.
That's true. Fair enough. Absolutely.
Maybe in the next couple of years.
But so today we want to sort of share this with you, not to talk about your history with the company, but let's touch on that a little bit, because I think it'll be interesting, because clients always want to know the kind of the origin story, right? But we're talking about your client case study, because you actually became a client last year, closed on a property, and had some really surprisingly good news that you just shared yesterday on our messaging group. And I wanted you to share that today. So where was this property?
This property is in Coleman, Alabama. Mm-hmm. A little in between like Decatur, there's Tuscaloosa, Montgomery, you know, it's kind of all in the middle of those bigger cities, but it's a pretty big city itself. It sounds pretty small. I hadn't heard of it before, but it's a decent size, and it's growing. A lot of tourists go there for, I guess, the lakes. It kind of goes back and forth between the second and third cleanest lakes in the U.S. So a lot of people go there for the lakes and the outdoor attractions. Mm-hmm. Only like a mile from one of the lakes. So
how much was the property?
$140,000.
And when did you buy it? Because it took a while to close, right?
Yeah, I started looking at properties seriously. I mean, I've been looking for years, but a little over a year ago, my husband and I are like, all right, it's time, let's buy. And then COVID. So we looked around we have some markets near us here, close, like in Indiana. So we looked at some there. We probably fell out of some serious, we were trying to put contracts on at least two. One got snatched up really quickly as we were trying to turn in the contract. Another one, we were under contract for a while. The inspection didn't go great. So we ended up backing out of that one. And then we went under contract in January for the one in Coleman.
Okay, so it took a few months to get it closed. You originally thought, and the proforma said that it would rent for, I think you said yesterday, $950. Is that correct?
Right. So it took a while to close only because it was a new build.
Right.
Yeah, $950 is what was projected, which was pretty conservative, obviously. But the property manager there was pretty bullish and was like, you know what, I think this can go for more. So we listed it at 1,100, and within 2 weeks we had several applications and quality tenants within the first couple weeks, and it was, they moved in 2 weeks later.
Sure. So your rent was more than 15% higher than expected, right?
Yes.
Awesome. Sound effects. Yeah, that's really great, Brittney. And, I think when you said that in our message group yesterday, I really thought that I, wanted to share the point. And one of the properties I sold recently, one of our clients bought it. He's renting it for way more than I rented it. And he sent me the thing and, showing it for rent. And I said, hey, I'm a little jealous. Why did I sell that? It is really amazing how much pressure there is in the marketplace to see rents go up. Obviously, prices have been increasing a lot, but the rent thing is a little more opaque. And let's talk about why, because I think it's really important that listeners and investors understand the opacity issue in the rental market. Number one, rents lag. They go up slowly. And they do that because typically they're on 1-year lease renewals, and they can't raise the rent except in those 1-year intervals. Mm-hmm. But owners, when they have that property, the tendency is to want to keep the tenant and not raise the rent too much. So they will make the mistake of being really conservative on those rent increases, not really understanding the market, not really understanding how short and scarce housing inventory is. And they'll give them, in a booming market, a measly $25 or $50 rent increase. Now, granted, we don't like tenant turnover normally, but sometimes the tenant turnover really is a good thing, because if you raise that rent $200 or $250, you might find that the market will totally accept that rent, just lickety split. Mm-hmm. And that tenant that is currently living there may not be able to afford that house any longer. The market may have passed them by, sadly, but that's just the way it works, okay? And so you may have to re-tenant it, but that may be the best thing that ever happened to you. So I just want to say to people listening, don't be too scared of re-tenanting your property. There are investment groups and apartment syndicators who literally have that as their business model. They buy a shabby apartment complex, and, well, frankly, I've done this twice myself with my own investments. They buy a shabby apartment complex, they fix it up, and they re-tenant the units one by one. When leases end, they fix it up, and you'll find that that newly renovated unit will go for $200 more than the old unit. They call it the classic unit versus the new upgraded unit.
That too in Orange County, where our office was before, that was happening quite a bit when I was there.
Yeah, it happens all over the country, all over the world, I'm sure, but in the U.S., it's much more.
Well, and Jason, wouldn't you say too that you get a higher quality tenant? If you're going up $200, $250,000 or $200 a month, your tenant pool could
generally
be from a
yes.
higher quality.
So in these apartments, they'll wait till the leases expire one by one, and they'll just do some minor renovation to the unit. And then that unit will be up way above the price of the units next door to it, quite literally. And it's the same exterior, it's just the interior is different. And I'm not even saying you have to fix up your properties. I'm just saying these rents are a lot higher than you think, folks. And the landlords have a lot more leverage than you think, because housing is in such scarcity mode right now. So raise your rents. If you don't raise your rents outright, charge pet rent, charge for extras. If your property has some kind of storage unit on it, you can charge extra for some things now and then. And we've talked about that on past episodes. But Brittney got $150 more than expected on the first rental. And probably you could have even gotten a little bit more, right? Based on all the offers and
maybe I didn't. So in this area, there's a small row of new homes. So I don't know if I wanted to go too much higher than the other ones that are renting for, just to keep maybe the tenant happy. But
sure.
Yeah, maybe even more. We were thinking 1150 to start, but we settled on 1100.
Yeah, good. So you got a lot more than the 950 you were expecting.
Mm-hmm.
So that's great. And folks, when you're looking at some of these properties to buy, you've got to realize that some of these rents are just understated or they're undervalued. You know, like my own property that I sold to one of our own clients, you know, I had it rented for like $200 less than he's renting it for. So shame on me. I'm not a very good landlord all the time. Sometimes I could do better. I could pay more attention to my own portfolio. You know, it's the shoemaker with no shoes, right? That old story. Too busy working for other clients, and sometimes I got to pay more attention to my own portfolio. So that's true. But Brittney, when you came to work for us, let's go way back 13 years now. Mm-hmm. When you came to work originally, you weren't looking to get into real estate. That wasn't one of your particular interests. You had a public relations major. You wanted to do marketing and PR work, which you've done for us for many years. When you got around it, what were some of your initial thoughts? You know, you went to some of our conferences, talked to a lot of clients and the investment counselors and so forth. What were you thinking back then?
Yeah, I was a young pup at the time.
Oh, you're still a young pup.
Well, you know, I was just so fresh, so raw as far as, you know, just jumping into the workplace and to finance and investing. And, you know, I was eating it up. I loved every minute of it. I loved going to the conferences, learning as much as I could, talking to the clients. I'd say the client testimonials and the case studies, I mean, those are always a favorite, right? And they were for me at the time. They kind of still are now, just hearing real life stories. But here I am 13 years later, finally doing it. You know, I probably looking back, you know, like you say, you know, I wish I would have done it 2 years ago, wish I would have done 3 years ago.
Or 10 years ago.
Yeah,
right?
It's true. And I remember at the time there's $5,000 down properties. That was the big thing at the time. And obviously that's not now, but I wish I would have snagged one of those up, even with my little money that I had at the time.
Yeah, no question. We all have our shoulda, coulda, wouldas. You know, we all have that. And it's like the old saying, what's the best time to plant a tree 20 years ago? The second best time today. You know, you got to just put your foot in the water and start somewhere, right? And everybody can only start where they're starting. But once you get into this, I promise you, it's addictive, and it's addictive in a very positive way. So that's really.
And Jason, to add your question, I think inflation, just the fact that you hammer in the idea of inflation, that's probably what hit me the most, and what I took out initially is just the fact that, you know, your debt over time, inflation just destroys it. Yeah. And I think that was what really at least kind of hooked me in. And obviously I've learned a lot deeper and wider, you know, in my knowledge since, but that's probably one thing that I first remember the light bulb going on.
Sure. Yeah. By the way, folks, if you see our graphics out there, Brittney creates a lot of those graphics. She's got a very good eye for design, and she created a great new one for us, inflation-induced debt destruction graphics. So thank you for that, Britt, because it looks awesome. You know, let's also talk about inflation in the sense that not only does the inflation destroy your debt, but let's look at the real price of properties today. And I think this is interesting. Now, we talked about the coulda, shoulda, woulda thing, but when you look at it in some other ways, it's not as bad as you think, right? And I've been talking a lot lately on the podcast and the YouTube channel about how nobody has been forcing any of us to store our wealth, whether it be big or small, in dollars over the past 10 years or 20 years. We could have stored that in gold. We could have stored it in oil. We could have stored it, you know, for the last 12 years or so in cryptocurrencies. We could have stored it in silver, in corn futures, in soybeans, in coffee, you know, whatever. Any commodity on earth could have been our storehouse of our wealth. Most people think of everything in dollars, even around the world, not just in the US, because the dollar is the reserve currency of the world. But we also always need to look at not just the price of the property, and the prices have gone up enormously. And that can be very discouraging for some who think, gosh, am I buying at the peak? Am I paying too much? I wish I would have done it 10 years ago. Yes, of course. I get it. I understand that. Okay. But remember, it's also about the payment on the property. And that's the way most people really buy a house. One of our clients that you know all too well because he used to come into the office, Brittney, that's Drew Baker. He's been on the podcast many times. He just bought a high-end property for himself and his family in Coronado, in Southern California, San Diego area, Coronado Island. Super expensive. And he keeps sending me messages, since he bought that property last week saying, I can't believe how cheap the payment is. It's incredible. And he said this today, by the way. Let me play this message for you. This is really, really telling.
Is I was looking at the amortization schedule of a $1.5 million loan. In 30 years, you only pay back half of it in interest. So if you borrow $1.5 million and you pay it back in 30 years, you're only paying $750,000 in interest. I mean, so in 30 years, you don't think you can make 50% on your money? I mean, hello, how much is inflation going to be in 30 years? I mean, it's probably going to be way more than 50%. So yeah, free money.
So isn't that incredible? So 3 decades and you borrow $1.5 million and you pay back $2,250,000. That is absolutely incredible. Right? That you only have to pay $750,000 to use that money for 3 decades until 2051. I mean, that's just incredible. It really is.
The interest rate was so low.
Yeah, it's absolutely amazing. So Brittney created a logo for my new economic index called the HCI, or the Hartman Comparison Index. And what it does is it compares a lot of things, okay? So 21 years ago, in the year 2000, if you wanted to pay your mortgage, not in dollars, but in shares of the S&P 500 index, the most commonly used gauge for how's the economy doing, right? They just look at the S&P. Well, maybe it's GDP, but the S&P is a really good measure. So it would cost you 11.12 shares of the S&P to pay your monthly mortgage payment based on the interest rate at the time and the price of the median priced house at the time. But today, just 21 years later, it only costs you 3.03 shares of the S&P to pay the monthly payment. So is it cheap or is it expensive? It's cheaper, okay? Now let's look at this in the mortgage payment based on the number of hours worked at the average wage. So that same mortgage payment in 2000, 21 years ago, it would take you 69 hours of work to pay your mortgage. But today, it only takes you 48 hours of work. So it's cheaper today. Now, mortgage payment and hours worked at minimum wage. Well, most minimum wage people aren't buying a house, but in case they were, right, it's a good comparison. In 2000, it took 192 hours at minimum wage to pay the mortgage. Today, it only takes 165 hours. So when you look at it like that, it's cheaper. But does that mean you shouldn't have bought a house back then? No, you would have made a lot of money because when the price goes up on the house, you get that in real dollars. This is just the monthly payment and the carrying cost. And one of the beautiful things about income property that I always say, and what I absolutely love about it, well, many things I absolutely love about it, but one of them is that you are never stuck with the deal you agree to when you buy the property. You always get to renegotiate the deal along the way. Mm-hmm. So for example, 21 years ago, interest rates were higher than they are today. 10 years ago, they were higher than today. So as you go through time, you just keep renegotiating the deal. And what do I mean by that? You simply refinance the property. You use my Refi Till You Die program that I've outlined on other shows, and you extract cash from your property. Hopefully you buy more properties with that cash, and you lower your payments as rents are increasing. It's just an absolutely beautiful asset class. Nothing else behaves like income property.
Yeah. And that's one thing I've learned over the years too, just how creative you can be, not depending on how your life is, your, risk tolerance, you can kind of structure it a lot of different ways.
Yeah. It's really just a super flexible multi-dimensional asset class. So that's what people love about it. Britt, anything you want to say to people listening who haven't started investing? And the reason I really wanted to have you come on the show is because this took you a while. Now, it's not like you weren't busy with other things. You know, you got married, you had a beautiful wedding. I was there. You moved around a bunch. You had 3 kids. Okay. So, you know, you've been busy with a lot of other stuff. But, you know, just what do you want to say to people who are thinking about it or are just barely dipping their toe in the water? And
I would say, even though right now you may not be able to pull the trigger, maybe you can. You know, I'd say if you can pull the trigger, do it, because, you know, again, even looking at prices and just things from last year, you know, I drool. Yeah. You know, looking at that. But just set some goals and really try to work towards that and achieve it. And it's pretty neat once you get into it. You know, I'm still pretty fresh. I just had my first tenant, but I'm already, you know, looking for others. Like you said, it's addicting, and just mapping out your 10-year plan and seeing what that could be. It's really exciting.
Well, Britt, thanks so much for joining us. Really appreciate it. And folks, if you have any questions, reach out to our investment counselors. You've heard Brittney on the show before, but she was never speaking as a client like she is today. And so it's just great to share that story. And congratulations on getting about what's it work out to? Maybe 16, 17% higher rent than you expected. That is just phenomenal. So congratulations on that. And happy investing to you, Brittney, and to everybody listening. And we will be back with another episode in 2 days. Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.